Welcome to the Gray Report. Are we starting to see light at the end of the tunnel in the commercial real estate space, specifically the multifamily market? Are those clouds, that sky, still so cloudy that we cannot see any stars? We can't navigate, as Jerome Powell said. There's probably a little bit in between. This week, though, on the Gray Report, we're trying to get a little bit of clarity with a new report from CBRE, their mid-year review. Another report from Yardi Matrix for their national multifamily report for August 2023. A piece from Apartment List, CoreLogic, and another one from the Harvard Joint Center for Housing Studies. But most importantly, you're going to get myself and Dr. Matt Bosnagel just pontificating about where we think this multifamily market is going, cap rates, the economy. Stick around. It's going to be a great episode. Welcome back to the report, joined again by producer, co-host, director of communications and marketing here at Gray Capital, Dr. Matt Bosnagel. How you doing, Matt?
It's another great week. Last week, I was just saying this before, and last week I was like, reality check. This week, I found some reasons for hope. I agree. I think there are some rays of light shining through.
I think so. Yeah, just a couple. It's not. We're not in full sunshine yet. But reporting live from the Gray Capital Studios, Matt, here in Indianapolis. Mm-hmm. It's been such a cloudy market. Yeah. I mean, the weather is getting a little crisper, getting into fall. I remember last year, and again, I hate this, going back a whole year, 18 months ago. Yeah, and we were having the same conversations about lack of price discovery, interest rates, and just being too damn high. But we're in a similar but not the same situation. I think we're on the other half of a lot of that, but I don't think we're all the way to the point of where the market is stabilized. Yeah, I mean, and this is a conversation ongoing between we're putting hundreds of millions of dollars worth of offers in at prices where we think make sense, and we're confident here at Gray Capital. Where a couple months ago we were 10 to 15% below kind of what the seller was looking for. Even a few of the other offers, a lot of those deals just didn't go through. We're so far away to what made sense, what we knew made sense, had an appropriate risk premium. We're getting close. We're not all the way there. Cap rates have come up. Last year we were still in the 4.5%, maybe even 4 up to 5% range. Now we're in called the 5 to 6% range. We're seeing some deals even above 6%, kind of in that mid 6 cap range, which is very promising. The challenge is we keep having the interest rates, and now specifically the 10-year Treasury, creep up. It's at one of its highest points. It's at, on the newsletter, the Gray Report newsletter. You can sign up for graycapitalllc.com/newsletter. I was looking at it this morning, Matt. Just under 4.3. Yeah. That's hard. So even as cap rates, and so here's the conversation that's happening right now, is sellers they've capitulated. Okay, fine. We're not going to get it for the 5 cap. Move to 5.5. Move to 5, 3/4, a 6 cap. Yeah. Then the buyers are saying, oh yeah, okay, now it's got to be 6.25. Yeah. Now it's got to be 6.5 because we're going back to our underwriting. And again, these deals were decided to be brought to market at a certain price, a month ago, many months ago. Yeah, they're adjusting their prices to what happened to. Yeah, that would have been great if it was July or something, but the 10 years gone up since. We're just in a different world. The 10 years gone up, and there are fewer and fewer comps that show sub 5 cap deals or even mid 5 cap deals. The deals that are being done are in the upper 5 cap range and the mid 6 cap range where it makes sense. Not that there are some exceptions. I know some groups that are still buying with negative leverage and deals that I can't really make sense of, other than there's for a good basis argument, and that's out there. Well, it's going to make it in the next 9, maybe 12 months a little rocky for them. Yeah, because rents we're beginning, like you kind of alluded to this. We're beginning a cooler rent season, and it may be even a little bit more cool because of how much apartment supply has been gotten. And we'll get into that a little bit. The supply, we're right in the middle of the supply being delivered, and people having to deal with it. Yeah, and so and we talked a lot about, and we'll talk even more today about that issue and how that's kind of unique in the apartment market, especially compared to the very strong demand in the single family home market. Yeah, but
ultimately, that strength in the demand of the single-family home market is going to redound to the benefit of the multifamily market and apartment rents. They're going to make apartments more valuable.
Now, on the single-family home market, and we'll get into this, is there really that much demand, or there's just so little supply that there is enough demand to keep prices where they're at?
I don't know that for sure. All I know is that like prices are a communication of the demand, and if
but also supply.
Yeah.
So, because and that's what I keep hearing is that we're all locked into these 30-year mortgages, sub 4%. Who's wanting to sell right now? And so there's so little on the inventory that the few things are getting picked up at actually higher prices.
But the amount of new homes that are being built is
going to catch up.
And this is the other big story that I noticed in like all the charts that I've been going through, especially in that apartment list one, which I'll again refer to, is a lot of these charts you're seeing. It is the real story is it's post 2008. All these trends of increasing share of new homes, that was going on since like 2011.
Yeah.
And the increasing home prices obviously has been going on since 2008. So it's steadily increasing only the last 3 years. And we actually, for all these trends, throughout 2020 was just about similar to 2019 when it comes to single-family home sales. But 2021, 2022, 2023, things really took off.
Yeah.
And, now I think we're getting on the other side of it. But not yet for single family homes. They just want to buy more homes, and you can't build them fast enough. Although we're building close to, it went from 5% in 2011, the share of new homes built, to now it's like 30 to 35. It's like insane. Yeah,
that's a lot of new homes.
Yeah.
So we still have supply working its way through the system. The whole idea of these higher interest rates are supposed to slow down the housing market, and it certainly has slowed things down. Again, maybe prices have stayed elevated in the single-family home market, but the volumes of transactions have certainly gone down. On the commercial real estate market. I mean, we all know the story on office. Multifamily pricing has cooled. Rent growth has cooled. Nationally, we're at negative year-over-year rent growth. You have, the Midwest and Northeast are really the only two regions that are seeing positive rent growth. But even in those markets, we're seeing much more, slower growth. In our portfolio trade out, I looked at this morning. We've got 10% year-over-year lease trade outs.
All right.
I don't know what we're doing,
man.
But a lot of them, a lot of new acquisitions and
that. But and then there's the region is really important. A lot of the reports that came across last week and the week before really emphasized the relative strength of the Midwest, and that's that's readily apparent in some of these reports. There's a Redfin report that came across that shows. So it compared regional rent growth. The rents in the Midwest were just like these stable, beautiful, smooth lines, and the rent growths in like in the Sun Belt and the Northwest are just waving all over the place.
Yeah. Well, I mean, it's a linear, Midwest mostly pretty linear, stable markets. No major crazy booms, no busts, and if you're smart, you can find where the booms are. So all of this, again, so there's two parts of the housing market. We've got the fundamentals, that supply and demand, what we're just talking about. Then there's the capital markets piece, the financing, the investment world that's so driven by interest rates, and it has made the transaction market difficult. One of the key data points we're looking at for where interest rates may go, what the Federal Reserve may do, what may happen with the 10-year Treasury, is looking at CPI reports. We had a CPI report print yesterday, Matt, on September 13th. Looks like our headline inflation on CPI was 3.7% before seasonal adjustments. CPI for all consumers was 0.6% in August. So this was more or less a neutral, I guess, reading. Breaking it down further, and Matt, I know you've done some additional analysis, breaking out just all items versus core. Core is all items, but taking out food and energy. All items, have ticked up since June and July, but if you take out food and energy, they have continued nice, steady decline, obviously indicating that, if food and energy, specifically food and salad dressing, as we'll point out, has, but really no, we're talking about energy, has really spiked over the last couple of months and has kept interest rates elevated. And we're looking at this because the Federal Reserve, the Federal Open Market Committee, is looking for signs where they can continue a pause, communicate a pause, which they probably won't communicate a pause, to eventually maybe even lower rates. And we're way far away from that happening. But are they going to raise rates? And all we're really looking for is we're just looking for a little bit of stability.
Well, that's what the investors do. I feel like, I feel like there's some itchy trigger fingers, and they're saying, oh, well, if inflation is still up, then sell, because that means that interest rates are going to stay up. I like to think that they look past some of the more volatile things like food and energy, but you never know. They may be patting themselves on the back for their hawkish stance, even though a lot of it is driven by things that aren't necessarily fundamental to the inflation situation in the United States, and maybe more due to, I don't know.
To them, the downside of raising rates too early is just unacceptable compared to just staying pat and steadfast and letting a recession happen, because they're like, look, we had potential runaway inflation. We had to do this. We all knew we had to do this. We had to bring inflation down. It was an existential threat, et cetera, et cetera. There's a lot more cover in them actually causing a recession rather than them, lowering rates prematurely and inflation, really.
See, I think that was maybe part of these expectations for recession in 2023 was like, well, rates are high. Every single time rates are high, there's a recession.
Yeah.
And it's easier for me to believe in that than it is to believe in a soft landing. Therefore, let's get it over with as soon as possible. Yeah. So why not have one in the middle of the 2023, then put it off?
No, I think that's the true. My preference to a soft landing is let's get it flushed out of the system.
Yeah, rip it off.
Especially if it's not going to be, catastrophic. If it's just going to be a real slowdown, I'd rather just get it over with. And but that may be. I think that it could be wishful thinking, because we've been talking about that for a long time. Yeah. And is that a possibility? It affects the way we're underwriting deals right now. Because you're really looking at two very different economic landscapes over the next 5+ years.
Yeah.
One in which, interest rates stay relatively, stay high, cap rates stay high or even go higher. Maybe you get some decent rent growth, maybe 4% instead of 3%, organic, because there's more inflation. You probably get more than that. Your expense rate's going to be higher. And that's what's tough, is if you were using a 3% organic rent growth rate versus a 2% expense growth rate, that ratio of 3 to 2, all of a sudden if you're using 4% rent growth and 3% expense growth, that ratio is off. So you're not going to get that NOI growth. So it can be challenging. You're hoping to see, really close to like 6.5% organic rent growth. You're getting 3% expenses. But you have to assume that that's a decent possibility, because that's the world we live in now
with inflation
higher for longer, as kind of a base case. But then also looking at if something we have a recession, maybe we'll see some rent growth slow down in that downturn, but then everything pick up. But then most likely interest rates would come down as inflation would come down, rates would come down, cap rates eventually would go up, then they would come down, over like a 5-year period. And so you can paint a picture that's not certain, but actually can be like really attractive and exciting.
Yeah.
Whether that's to refinance when rates are lower, or to sell in 3, 4, 5, 6, 6 years. Right now, when we're looking at deals, they're low leverage, again, high interest rate. It's hard to underwrite at today's pricing.
Yeah.
Above a 13 IRR, 12, it's like 12 to 14 IRR. 16 if really pushing it on a shorter hold period, but it's kind of in this 12 to 14 range, which is lower than we'd really like to see. But that's in the base case of staying higher for longer. If we see interest rates go down, even with rent growth dipping down, that's all of a sudden a scenario where through refinance or even an earlier sale, or even a sale later, just in a different interest rate environment, you're seeing the 16, 17, 18, 19, 20% IRRs, which on these at face value looks like a 12 or 13. You can paint a picture at, we can get to the 16, 18, 20, but you really can't look at that so seriously other than just to know that is a potential scenario for upside. But it's, the probability is, a little bit unknown right now.
The alternative is so scary, and that's what's scaring people away. It's like we know what's going to happen probably in like a year, but 2 years or 3 years, that's like we're either in the wake of something or we're dealing with something.
I don't know what's going to happen in 3 months, man.
Yeah. Oh, I do. Wait till later the report.
We can, and that, perfect. 360. I mean, that's the crux of I mean, like the next 6 months right now, I can see so many things happen or not.
Yeah.
But so many things really could happen in an agnostic way, good, bad, or an indifferent. We're going to see some movement. You know, if you look at CoStar right now and some of their cap rate forecasts, which again, like I don't put too much credence on. Yeah. But like according to their forecasts, which again are often wrong. These Cambridge Analytics, I think, is a lot of their data, and it shows we're basically halfway through a period of expansion.
I was just thinking about that because I was pulling up the same stuff. Like there was a worse time to sell, but you still may, there still may be more to go. Yeah. I don't know. I don't know how true that's going to be.
It is the future is unwritten. We don't know, and there's no way we could know, because we just don't have the data. We haven't been there. We don't know how the next couple months. Yeah. I mean, again, we have to get through these. Could be speed bumps, potholes, or sinkholes that are all these loan maturities that are coming due. Yeah. Starting really next month through 2024 and halfway through 25. I mean, we also have, I was just, reading recently, the amount of loan maturities of treasury maturities that are coming, U.S. treasuries that are coming due mid next year as well. So you talk about us, moving some rates. I mean, they were issuing bonds at, next to nothing, 1-2%. And now the coupons that they're paying, which means the debt service that the federal government is having to pay, is going to really balloon. It's going to be a hot political topic, but it's going to be a huge economic topic. But it's going to put a major constraint on future government spending. We're already spending all this money from still COVID dollars that's trickling out or not, trying to some ways ratchet it back. But so we've got these things that are still out there that could all be totally fine and absorbed and worked through the system. But then, as we talked about last week, there also could be a lot of like secondary and tertiary downstream derivative effects of, some very seemingly sort of very smart and even conservative at the time, but financial strategies that actually use quite a bit of leverage to gain a return off of, relatively conservative instruments like mortgage-backed securities and, assuming things about interest rates, and all those models are really broken right now. And again, it's not just because they've seen The Big Short like 5 times, or it's because, I've been in the industry, and some of the things that I've seen happen over the last couple of years makes me think that we really didn't change that much, other than, we're not talking about residential mortgages, we're talking about commercial mortgages. The credit standards, lending standards, they were improved, especially on the residential side. And there's a lot of standards there are a lot of standards on the commercial side, but there's also a lot of like games people play on the lending side that I think there are some practices that are like very well accepted, and some things that are I think quasi fraudulent in a way of just cooking the books and making just unrealistic projections, and just getting just crazy appraisals. So there's a lot of things that like at the time I'm like, ooh, that just doesn't smell right. But hey, the market's going up. You figured it out. Like I'm not, I ain't no snitch. Like, okay, you do your, I've got a different way of conducting business, but whew. And now
2 years.
See 2 years. And literally lenders being like, yeah, this is a horrible deal, but we convinced the agencies to just, hand them a couple more $1 million, essentially. The bucket was overflowing. So that's again, like, can all that be worked out? And if we have a recession sooner, interest rates fall, everyone will be, maybe.
Yeah. So that's, there's the hope. People were wanting pain so that everything could clear out. It's not necessarily going to happen quick. But although I did want to just note, did we note that the top line numbers for inflation are 3.7, which is up from the previous month. That was the year-over-year number, and the month-over-month number was 0.6, which is very high. If you expand that, 0.6 times 7 point? If that was every month, it'd be 7.2 or higher. It kind of analyzed.
What was the
core increase. Now I was looking for that.
On the spot.
The index for all items less food and energy. The core rose 0.3%, and the yearly number for that was 5.6. No. Well, anyways. The point I wanted to make about core and regular is that core is clearly going down. If you take energy out of it, gas prices went up in like a month. They went up like 10 or so %, some ridiculous amount. And it was responsible for over half of all of the increases for all items. And it wasn't necessarily wasn't a story about food. This was really a story about gas prices. So that's what's driving inflation right now. If you want to find a reason to be hawkish, then you'll look at the top line number. If you want to say, oh, maybe things are still steadily but slowly going down, then you look at the top line, because top line it's not like it's sinking. It's not like it's negative.
And this is the one case where like core is kind of helping us out. Yeah. Because a lot of times core can be a little bit higher, but or lower. But the reason why they do break the two out. And there's a lot of different ways to look at inflation, CPI. I mean, there's one, the X housing, the PAL looks at a lot also, the core, but also taking housing out. You can see that it's because energy specifically is much more volatile. They take housing out because it's like such a lagging indicator that it kind of clouds what's inflation rate is today. Yeah, I'm surprised they don't just report on that.
Yeah, I know.
I know that they do on like the Fred website and stuff like that, but I should throw it in to the the BLS folks.
I think they should. I'll get that.
Is there a guy?
I'll find a guy. If there's got to be a guy. Hey, I'm not looking for Powell, or I'm not looking for the head of the Bureau of Labor Statistics, but there's probably his assistant,
and they'll be like, oh, it's just the.
They're gonna be on next week.
Here, Matt.
Press office at bls.gov.
Yeah. Press office at bls.gov. They will get right back to you. I'm sure CPI_info at BLS. Everybody, why don't we send them an email?
Yeah. I've got a great suggestion. You probably haven't thought of this, so you're welcome already. And then I'll tell them about our ideas for tracking housing a little bit more accurate.
Do you think they answer their phone?
I hope so. They're gonna give us an email address. The end of the phone tree is always a website now.
So we will report back when we get comment from the fine folks at the Bureau of Labor Statistics from the U.S. Department of Labor. Matt, next on the report, do you want to jump to the CBRE?
Yes, definitely.
Article? This is just it's really good.
Very similar, and we've been kind of alluding to it throughout our earlier discussion on the CPI, but a lot of good takes in here, and it's they're giving a lot with their takes. They had some predictions earlier in the year, and this one is an update and a review of how successful they were, how far off they were, and if anything's changed about like their fundamental thesis.
There's a little bit of humility in this.
Yeah, it does seem like, and I kind of respect them putting themselves out there, because then they can be proven wrong. And rather than like hiding that, like, oh, it may happen, like here's it's going to be, we expect just a little more trouble. No, they gave us numbers, and the numbers are either right or wrong.
Well, and who knew?
Yeah.
I mean, what prediction from the beginning of the year or the end of last year for how this year would go would be correct? So it's
but yeah, I can kind of run through these predictions really quickly. All of them are guided, I think, just like, and I know we discussed this early in the year, their early year predictions were guided by an expectation of a recession that has not come to pass. And this is, and they kind of summarize it here too, saying CBRE has pushed back the timing for a potential recession to late 2023 into Q1 2024, 1 quarter later than our original forecast. We therefore have extended our forecast for recovery in commercial real estate investment volume and stabilization in cap rates by roughly 1 to 2 quarters, pushing expected improvements into 2024.
Yeah, it is not. I like this format maps. I mean, they're basically saying, so recession, they laid out economy. We thought there was going to be a recession into the 2023, but obviously we don't think it's going to happen. But we're pushing. A lot of this is we're just pushing it out. We're just pushing it down the road. We're just pushing.
Doomsayers, don't worry about it.
peak interest rates. They basically said that we're going to peak at mid 2023 at around 5%. Well, we're at 5.25 to 5.5, so they're not like too far off.
Oh, it's going to happen. They just say, and what I think a lot of probably cult leaders have said is the apocalypse is still coming. It's just merely rescheduled. So don't worry.
Yeah, end of the world cults always in vogue, especially nowadays. We will now, but looking ahead to interest rate predictions, Matt, and again, like at least even if we don't know, they don't know, but they're at least giving some thought to it and putting a number on it, and they're holding themselves accountable, which we appreciate. They now believe rate decreases will start in 2024, and the Fed funds rate will end the year at 4.5 to 4.75. We also see the 10-year rate ending 2023 at 4%. That's possible in 2024 at around 3.5%. And then again, that's what we were talking about, just a couple minutes ago on looking at these deals today. And you can't be banking on the rates going down. If your business plan is dependent on interest rates falling, you're putting yourself in a trap essentially. But if it works when rates stay high and looks good when rates stay high, or pretty decent, it's not going to look like a blockbuster because you're not getting the leverage. You can't assume that much growth. Interest rates are high. So you're not going to see just blockbuster deals. But what you have to understand is there's this possibility for major upside if rates do come down. Not that they will, but if they do, you can really kick it out of the park, because a lot of these assets, even today, even if like the risk premiums don't make sense relative to other areas of the market, looking at a basis standpoint, the price to build some of these assets is way more than it costs to buy them right now. So like what you hear a lot of brokers saying, and you hear a lot of buyers, and when we're looking at a deal, sometimes we're like, man, on a price per pound, on a price per door, it's a steal. Like I can't build it for that. And we need housing. So tell me why it's a bad idea. It's like, well, it's because you're only going to get 55 or 60% leverage, maybe 65. And the interest rate's going to be 6 plus or minus or plus. And, we can't model that much rent growth. You got negative national rent growth right now. Maybe things will pick up, but it's like you can't be confident unless you're really looking at some comps and you know something. You're not going to push up that much organic than you already know. So your returns aren't going to look that sexy if you're reasonable, but you also know there's a big chance for upside. But it just, you can't I think someone who that can't be your base case.
Well,
it's not even your best case. It's just kind of like, we know this is a possibility, and so where it's interesting, but there's so many variables. Like you have no idea what that's going to look like. I mean, we've been modeling it, but we don't.
You're saying this from the perspective of like the buying and selling market. I'm thinking of it. These sellers coming to, if they have loan maturities, they're going to the bank and they don't have as much to come to them with. If it was last year regardless of what the interest rate, if it was last year, it's like, oh yeah, look at all this rent growth. We're great. This year year over year, they've got steadily declining rents. It's going to be less persuasive in terms of NOI. I don't know.
No, it's a great point. No, I think everyone was saying because they're reading the CBRE report, let's assume for just a moment the CBRE report was general kind of market consensus. That was in the zeitgeist. That's what everyone was thinking and saying was a reasonable assumption, including buyers and bankers. Like, hey guys, we're going to wait at least at the end of the year. Let's see what happens. We think you might be able to get some rent growth because, you thought you could. And then also, we'll see what rates are. We're looking at forecasts showing rates are going to be coming down at the end of 2023, which should work out perfectly for you.
CBRE got rent growth wrong too. CBRE overestimated rent growth. And so it's like a more perfect storm for people that are facing loan maturities than maybe they thought at the very beginning of this year. Like rates are staying high, rents are staying lower, and
everyone thought rates were going to be low by then. Not everyone. A lot of people said, we think the majority, the consensus was rates will be lower at the end of this year. Rates are like definitely higher. I mean, end of the year is 3 months away, or less than 3 months away, right? We're in September, October, November, December.
There's not a lot of room to move here. I'm not sure exactly how many times the Fed is going to have an opportunity to raise or lower rates, or how many meetings there are remaining in the year. But 3 out of 1, even if they lower rates, it's not going that much lower. It's hard to see them.
There's no way. The zero. I mean, low digit probably they're going to be lowering rates with, with the current data, like there is no chance that they're going to keep them flat. I don't think they'll raise them. They could.
Yeah.
But I think it's going to be neutral. They're going to hold pat until if they see if there's another month though of like things popping up. Now shelter, which we've talked about a lot, Matt, should really be coming down next month.
Yeah.
That might bring things down, stabilize it.
That's a good point though. If CPI is like it is, even if it does, if it stays where it is, or even just goes out a little bit, it's so much more likely that the Fed would raise than lower at this point. But I think that the upshot to CBRE's whole thing was that no matter if the recession comes, now I called it doom, but they said that the steep downturn is not expected, and everyone complains about the Fed.
There are other predictions, right?
Yeah. So I don't know if it's going to be a recession, and I'm not brave enough to make that call. But I think that ultimately, like these past 6 months, or really 9 months, of operating under different assumptions, the market could have moved much differently. Maybe things, if we knew what was happening in the next 3 months. I don't know. It just, I keep coming back to that idea. Yes, their thesis has changed, or yes, they did not change their thesis and they merely extended it, but extending it in and of itself is a little bit of a changed thesis. Timing is really important to the investment market, but whatever. I kind of want to get into the multifamily specific portion. It's a little bit lower down on I think it's right after industrial.
Yeah.
They do make multifamily. They follow up on their predictions, and I noted one of them, which was their rent growth prediction, initially 3.5, and now they think it's about 2.2. For the following reasons, they say they really are. I don't want to say over justifying, but they're telling us they got it wrong, and here's why. One reason was the lowering of CPI inflation expectations to 3.7 from 4.0 for the year, which will have a 1-for-1 downward effect on normal rent growth projections. Second is a downgrade to their employment outlook. And the third is significant deviations from earlier expectations in quarterly data for numerous markets. I think that fourth one's the data. But their employment comment is interesting because I thought that part of their assumptions of recession earlier in the year were associated with employment, or at least that it would either cause unemployment or be the linchpin of the recession definition. So I'm not really sure how their downgraded unemployment works out here. But regardless, they did adjust their expectations, I think, pretty accurately. And they also adjusted their expectations for supply and demand. Supply, most notably, they went from expecting, now this is just projections, their expected supply numbers were around 300,000, and they changed it to like 450.
Yeah.
I'm sorry. It was expects 350 units to be completed in early, and then 450,000 is what they now expect. Seems like the supply things are getting unclogged, or whatever snarls used to be.
And for so many, now we saw estimates of 500 and 600,000 at some point also. Those have all gone away. Probably some of those projects got canceled. Usually we under-deliver a little bit. In the past couple of years, at least, we've under-delivered what we've expected, and so this is a different case. But I think it's also the essence of moving around so much.
A lot of them seem to be around 400,000, which is still like really great and like amazing numbers. But it's not not the huge numbers that are still in the pipeline right now.
No, we were doing around 300,000 a couple of years ago, and that was like considered very pretty healthy.
Yeah.
So and again, we were digging out of a deficit of lack of construction.
Yeah,
so.
And earlier in the year, and I'm not sure if the number's the same, but there were about 1 million units under construction at some point. So a lot of those could shake out.
Well, let's hop over and see what our good friends over at Yardi Matrix have to say. Similar report, different report. This is more looking at August, whereas the CBRE report was really a first half of 2023 and kind of recap from their beginning of year predictions. Yardi is always always look forward to their reports. They do like a lot of good work. Indianapolis not on the front cover. It's okay. We'll take we'll take a month or two off. I mean, it's crazy that Indianapolis is the top market for a Yardi for just month after month after month. This is looking a little sunnier. Are we in Miami here?
Maybe, perhaps
that would make sense to me.
Yeah.
What are the takeaways?
It's interesting. Just a note about the Indianapolis thing. Yardi was on it really quickly. And it was only like 3-4 months later that the other outlets were finally noticing, hey, did you know about these Midwest markets? So
that's a good. I remember, Paul Fiorella reached out to me. This is like early on, and when Indianapolis at the top of the list, and Paul helps put these together at Yardi. I think he's their national research director. He just emailed me. He's like, just what's going on in Indianapolis?
Yeah,
I need a breakdown. What is happening in Indy? And it's not like really a crazy story, other than just it's a very affordable market, really balanced supply, solid economy, good job growth, decent population growth, like good taxes, good. I don't know. It's pretty simple. It's nothing like sexy.
Yeah. And some of these reports are basically say like this verbatim is like these top markets where here it is. Most metros with the highest year-over-year asking rent growth, which are, such as New York, Chicago, Indianapolis, and San Diego, benefit from a weak new supply pipeline. Now, if you looked at these, you would see that supply has increased in the last 3 years, but the supply everywhere else in the nation has increased, and probably greater than these. So it's a relative increase, and you can tell if you look at the regional numbers that Midwestern markets just are just more stable too. And so I think that's a benefit outside of any short-term supply.
Yeah, I was talking to another multifamily investor operator today, and we were talking about some of the challenges of supply, just even in some of the Midwestern markets, even if it's nothing compared to the national markets, but it's still like kind of double what we're used to in the Midwest.
Yeah,
and there's a property in a market that we're in. We have two properties in this market, and new construction is going in down the street, and they've got a construction loan. They need to get the thing leased up as soon as possible so they can get this construction loan off, and they can either refinance or sell it. And so they're trying to get it leased up as quickly as they can. And so they've cut their prices on all their rents just to get it leased up. And it's a smart strategy. They basically say, we have a Class A property that was built in 2016 in this market. They've just set their rents at where our rents are. But they're a property that is 7 years newer. So it's like we're both new both
so
look nice.
Who is it that's selling this? Or that needs to up the rent?
So they're trying to lease up the new development.
Yeah. That they just built.
Because
they don't want to operate.
They don't mind. They would hold on to it. Okay. But either way, whether they want to sell it or they want to refinance and hold on to it, they got to get off this construction loan. That's a floating rate coming up. It's going to be maturing. They're paying 8+%.
Yeah.
They're not having fun. They want to get on permanent financing as soon as possible. Like they got to do something, and time is money. And especially if you're going to sell it, your IRR fluctuates so much depending on how long your hold period is. And so they need to lease it up as quickly as they can. And so they're buying occupancy, and they're saying the value for the time value of leasing it up quickly and getting off the bridge loan is much more valuable than leasing the units at a higher rental rate. Yeah. Because also they know that if they go to sell it, now like if they're refinancing, they might not be able to get the proceeds they want. They get a permanent loan, but they know if they go to sell it, they can easily sell the dream of look at where your rent comps are, and you can raise your rents $400. So you've got a value add on a core plus brand new.
But the valuation would be based on all those discounted rents that they gave.
The valuation on the refinance certainly would, but the valuation to a buyer is, in the eye of the beholder. Yeah, okay. And if someone sees, very empirically that the rents are $300, $400 below market, they don't have to do anything. And like they have the high degree of confidence. Like I know that they could get higher rents because I just know, like I know what we have in the market, what we can get. And I know that they're newer, and if they're just a little bit newer, a little bit nicer, they can get a little bit more in rent.
But like on a technical level, though, and this is
hundreds maybe not. But
on a technical level, though, the cap rate would be based on those low rents, and then it would either be like priced at a
lower cap rate. So like if I wanted to buy it and I'm like, yeah, you've got low rents, but I know I can crush it.
Yeah.
I might pay a low cap rate.
Okay.
Because I'm not thinking as much about, I'm not doing anything. I'm buying it as is. I'm going to go in there and I'm going to increase rents and I'm going to look at my, like stabilized yield on cost, what the cash flow is. Now you're speculating and you can get caught. You can buy, because a lot of value add deals, especially in a couple of years past, people buying value add deals that, if the rents, if you can move them quite a bit, you can pay a low cap rate. All of a sudden the cap rate doesn't matter as much as where you're going to take it. The difference between where it is and where you're going to take it, that there's a lot of standard deviation. That's where the risk is. And then it's operational risk. If is it you've done it if you've done it 100 times and it's like got the systems down, but you also can get too comfortable even if you really know how to do that, because then you can just assume you're going to get $250, $300 rent bumps.
Yeah.
All of a sudden the market can't support it, put all this money in.
Yeah.
And you have a high basis, but you don't have the incomes to support that refinance or sale.
It does seem like, like a rough first year. Oh yeah, we're figuring a rough, but if that turns into 2, and that turns into 3, and then even if it's just 2 years out of maybe the 5-year hold period, then that's hurts you so much. And you just,
You're not hitting your numbers. You're not distributing what you told investors you're most likely going to distribute. And you've missed your numbers.
Yeah.
So that's why you have to be careful. But back to supply.
Yeah.
Even in the Midwest where fraction supply is coming on relative to nationally, we're seeing the effect. And again, I was talking to this owner. I'm like, I can only imagine what it's like being in a Phoenix or Atlanta or Charlotte or in Austin, when you just every deal is coming online right now, and everybody's competing for many of the same residents, and everyone is on the clock. It feels so good. We're not on the clock.
Yeah.
We had one bridge loan.
To think that we're in an environment, and I think that that's a really good insight, though. I don't know, it's an anecdote, it's just one thing, but what if that's analogous? What if, we are in an environment where every other block, there's a new apartment coming up and the builder is willing to make rents super low. So what is that going to do to your rents? What's that going to do to your vacancy? And that's got to be what a large part of what made rents so moderate in 2023.
Yeah. Well, two things. One, it goes to prove the idea that new supply is the only way to keep rents affordable. Is building more. It's the only thing that's going to keep rents moderating, because they would be pumping up right now with all the demand and housing being so expensive. We weren't building a lot more. But it's also, it comes back to idea that some really smart people were telling me when I was just getting into this business is that if you have something, if there's an advantage of buying the worst house on a bad house on a nice block, because you can make it better. But there's also, if you have kind of the nicest thing around. When things get bad, you can always compete for residents.
Yeah.
You can always fill up. You have to lower your rent, but you can always steal everyone else, because you're paying X for that dump over there. Well, same price or cheaper, pop it over here, live the good life. It's easy. Now, it's called buying occupancy. You're going to be missing out. But if you're at the same time, if you've got it's the idea of it's, heads and beds. We need these things filled. Yeah, we're not maxing out. We're taking some loss to lease, but we're still, our occupancy is going to be making up. And it's just a different market environment than we've been in the last couple of years, where it's like, no, let's sit at 94, 90, 93, 94, 95% occupancy and max our rents. We'll have a little bit of vacancy. We'll get overall, more revenue. Now it's like, okay, well, we've kind of squeezed the turnip as much as we can. There's maybe even a whole lot out there at a higher rent level because there's so much competition. We actually just, we're not going to lease anymore at this rate. We'd rather just release a few more at a lower rate and get some more revenue.
Yeah.
Hoping that, you're not getting messed up when all of a sudden the market turns around and you want some availability to lease units.
Yeah, no, it's super interesting as an example of the different pressures of when the person that's living in the house is buying a loan, single family, their market is going to be moved by different forces than a market in which the person impacted by high interest rates now is not the person living in there.
Yeah.
And that's what we're seeing now is, a motivation to keep rents low by people who that want to make their loan get occupancy rather than, in the single family, it's just a completely different.
Yeah, you just got to you make your mortgage payment.
Yeah,
It's can I afford it based on my income, and it is what it's not a lot more.
And that description that you gave was super interesting because it suggests such a direct link between this new supply and the rent patterns. Not that there is flagging demand per se, but it's really this tight spot that some of these developers are in, where they've got to get their apartments filled.
Mm-hmm. Man, New York City, New Jersey, Chicago, Indianapolis, Boston.
I also wanted to
top 5 year-over-year rent growth, all asset classes. Kansas City, San Diego, and Columbus. After that, the lifestyles. This is Class A. New York at the top. Kansas, Chicago, Boston, Indy, and then year-over-year renter by necessity. New Jersey, Boston, Chicago, Indianapolis, New York, Kansas City.
Super interesting how much far ahead New York City is at the top of the lifestyle asset class, and similarly, New Jersey is ahead over the rest of the competition when it comes to the renter by necessity asset class. There's something about that metro that's really recovering.
More money, more problems. I don't know. Yeah, it is interesting. Now, we'll remember New York City was a market during the pandemic that saw some pretty drastic cuts.
Oh, okay.
Maybe not as much as San Francisco, but like along this, there were huge pandemic. The rents just dropped off a cliff in New York. So there's a little bit of returning to that. Now I think that they've already made up from those losses, and now they're probably pushing ahead. But you have to think about the compounding. So a market like Kansas City or Indianapolis or maybe Chicago, definitely Indianapolis and Kansas City, there's been compounding growth.
Yeah,
there's been no real declines. It's been growth, compounding after growth, rates of growth after rates of growth, rather than like, okay, we're growing after a decline.
Yeah, true.
So there's some kind of base effect, statistical things to take into account. But yeah, it's fascinating. You don't usually see Indianapolis on a list with New York, New Jersey, Chicago, and Boston.
That's a good point. Yeah, Kansas City for that matter.
Indianapolis, the new Big Apple.
It is. There a lot of people saying it.
It has been said.
Yeah.
Do we ever want it to be? No.
So kind of,
I like New York.
To return a little bit to the Yardi Matrix report, I really liked their focus on the expenses. They had a little poll out that broke down the amount of expense growth in total, which was 9.3, and then they broke down the individual factors that are driving this. Chief of which is insurance, which yearly jumped over about 18.8%. That was the increase compared to last year. For repairs and maintenance, it was they were up 14.4%. Administration costs were 11.8%. Utilities and payroll each up 7.8%. And taxes, and they say, quote, perhaps surprisingly, increased by only 5.9%. And then they note later that even though costs are growing, revenue has increased more rapidly than operating expenses, which represent 43% of gross income per matrix. Income is
some cases
growing, but
income is growing, but except it's not right now. Income has grown, but it's typically most of the nation is not growing right now. It's declining while you're still seeing increases. The idea is that most of these increases have leveled off, but I think that's what we're still kind of waiting to see. Are we going to see increases? But it's like one thing after the other. It's like you get your payroll increases, and you get the lumber increase. I went down, and went back up, and all the materials, and then you get insurance renewals, and it's like it just. Nothing you can do about nothing really.
It's a rolling thing, and that's what's so
property taxes. And then it's like one thing after. We've been fortunate in the Midwest. It's not like out in Florida or Texas. But we've still seen our insurance double over the last couple of years. Where they've seen maybe there's like triple or quadruple in the last year in the Sun Belt. But it used to be like a very standard underwriting assumption, and this is like going back a couple of years, but not too many years ago, like $250 per unit to $350 per unit was like a very reasonable insurance assumption. We looked at a deal in Florida, and it was $3,700, per unit.
That's 10 times more than 10 times.
Yeah. Now that was in Florida. Now they were probably paying more than $350. Now I'm talking Midwest versus like this was like on the coast.
Yeah.
But now our insurance quotes for our existing deals are anywhere. We're going to get like solicitations from insurance. If you're in the insurance world, we really appreciate you. Like we don't necessarily need any other quotes right now.
Yeah.
But like, we're paying like, $450 to $600 to $700 per unit now, which is like more like double. Like we're good. We're in the process. Like we don't need any.
Yeah.
Appreciate your help. But yeah, it's what do you nothing you got to insure it.
Yeah,
I mean, because it's a lender requirement and you want to, and it's tough. Nothing like all you can do about it. Then you get reassessed. Again, very fortunate. Indiana's super, very tax friendly. We do entity sales, but that's something we're looking down the line of. Like that's just the next shoe that could drop. That can be another big whammy on expenses. And if you have stagnant rents for a couple of years, those cash flows are going to get even tighter and tighter. Yeah. And then that's another thing that these sellers, talking about price discovery and buyer, the sellers coming up to the buyers are getting closer, but then interest rates go up, and then the buyers get further away, and the sellers come up, and then insurance rates go up.
Yeah.
I mean, that's literally what's happening. Is like we're putting offers on deals, and the 10-year bumps up, and then we're getting close, and we finally get our insurance quotes back, and it's more than we thought on, and more than it was on the last deal, and it's like prices have keep coming down and down and down, and we want to find ways where we can be like aggressive in a way that if it's a deal we want to go after, but we also have to live in like reality and what things are going to cost. Yeah. And again, to seller, so it's like do you look at their T12, their T3? And or how much credit do you even give to any of their past financials? You have to obviously like some, but you really have to do some forecasting. And we talked about this last week, Matt. It's just some of these model. It's the tool we have. It's the tool we have for what's a good deal and what's the deal going to look like. But it's not really.
You can make it do whatever. You can assume.
You can make it assume whatever, and it's just like they're not good. I don't know what the tool is, but like they're not like great tools for what we think that they are. Like
now we're talking about Excel spreadsheets where you put in XYZ. This is what we think this will cost. This is what we think this interest rate is. But this is what rents are going to go, and it spits out where
return
or not buy.
That's bare minimum. It's like yes or no. Yeah, like we want a yes or no at what price. But then also it's also a process of building a business plan of we're going to implement this technology. We're gonna do that thing. We're going to renovate that unit. We're going to charge this for. So there's a lot of like our plans that are in there. But essentially we're trying to like forecast through numbers of all these human actions and prices of things, and certainly over the next year or two when the core of the business plan is executed, but then like what something's going to cost 7 years from now. And basically you build in some movement, your business plan again, 1, 2, 3 years, refinance, you hold it. We typically model it, we're just going to hold it. So we don't know what interest rates are going to be. But then it's kind of just like you just have like some growth rates that you're assuming everything's flat, but then you're going to grow, your rents by 3% organically, or 4% or 3% or 2.5%, 5%, whatever. 3 is like the standard. Grow expenses by 2%. Now we're doing it by 3. Maybe it's 2.5. Maybe it's
all these
again. This is what I'm talking about. So we're trying to forecast for inflation over the next 10 years, and we can't even figure out where it's going to be next month. So it's like, what is the purpose of that, of like the underwriting model? It is to give us a green light, and it's a risk assessment and it's a risk quantification tool of like, how can we experiment through the best analog that we can, looking for a yes or no at a certain number, generally what we should do. But it is not a truth. It's like not a real it's not a forecast worth much, is what I'm saying.
It follows maybe your attitude towards
general direction
rather than guiding, or at least it could. I think that I think it's like turn to the model when you're on an empty stomach, or turn to the model right after you eat. Figure out what mood you were in, and figure out how much they're different. There are times when that when you can look at the same thing and you're like, oh, I wasn't thinking about that, but now it looks this is horrible.
We didn't know that all these people would do this or would respond this way, good, bad, or indifferent. And
usually things go wrong. And that's what I think about optimistic models is, usually things go wrong.
Yeah, they can go. I've seen it both ways.
Yeah,
and that's the thing. I've seen like most of the models that I've seen, and part of this is just the fortune of being in the market in a very opportune time. Like, absolutely, is that they were underestimated. We would achieve NOIs within a fraction of the time that we modeled. I mean, our deal villas, we're crushing we are at our year 10 NOI in year 3.
Okay. Yeah, pretty good.
How would I have modeled that?
Yeah.
And if I did, everyone would look at me like I'm absolutely insane. And now even today, I'm like, we've done it. Not going to do it. Not going to put it on paper to say we're going to do it again, even though like it's happened. But then there's other cases where, I'm trying to think, we haven't, Pinnacle, there are some things that happened with the prior ownership. It went from, 90% occupancy to 40% occupancy over a couple months. And like, we didn't model. We were doing a lease up.
Yeah.
Whoops. We didn't know. Learned a lot on that deal for sure. It all worked. And then we ended up still beating our projections.
Yeah.
Nothing like the model.
Well, and that's a case study of
model out the
and that's a case study of the environment has been very forgiving of, but it's I don't think that we did everything wrong. I think that we could have fumbled it. I think that also there was a lot of doubling back that we did specifically and like put some real elbow grease into it to turn it around.
Oh yeah, we made it. We made it work, and it ended up working out. Partially, the market cooperated for a period of time. I mean, longer than we thought. But then we got our hands dirty and cut it done, and it doesn't work. Matt,
I want to lump these.
Where do you want to go?
These last 3 pretty much. There's one from Apartment List, one from CoreLogic, and one from the Harvard Center for Joint Housing Studies or Harvard Joint Center for Housing Studies. And there's I covered the Redfin, but this Apartment List talks about rents continue to dip while home prices rebound to all-time highs.
Matt, you were telling me the other day that housing is correlated, rent and single family.
I know. I felt a little bit wrong.
We both told people that. What is this?
So and I ultimately I think that's I know. But I do think that they're still very correlated. You can see on this chart that we have right up here, rents raising and home prices raising. They're both raising, but they're both going up. But home prices have gone up way more than rents. The math that I did, now I was making almost this same chart that you see on this screen. Before I saw the Apartment List article, I made my own, and lo and behold,
Apartment List Igor from Apartment List he has some remote desktop.
Maybe
computer. I in there.
It was he assigned it to Rob Warnock because he is that was the researcher in charge. But
I saw the graph you made, and they were like the exact same graph.
Yeah. It was funny. I was like, well, you know what? To me, that showed that I was kind of on the right track. That people are noticing this too. You see a lot about, and for valid reasons, a lot about apartment rents going up.
Why are we looking at Apartment List? Why are we looking at Great Capitals?
Well, and we will have that blog because the rent growth story is for the past year at least has been the story of in the wake of this massive increase. So why are home prices doing the same thing? And it's because of just what we were talking about with apartment supply. There's been so much more apartment supply, and that has impacted the apartment market way more than the new homes, for as much as they're being built and filled, and way more than the new homes have affected home prices. I'll admit that I'm more interested in these recent trends within like the past year than I am like this long-term trend since 2008, blah, blah, blah. But ultimately, housing demand is housing demand. And I think the long narrative, the most powerful kind of charts that we see and maybe can't display because the Harvard website is currently down, show that all the strong trends are from 2008 to now, or 2011 to now, whether it is the proportion of new homes that are being built, whether it is like kind of home price growth, all that's happened in the past 3 years when it comes to apartment apartment rents or home prices, but specifically home prices, is the existing trends of greater housing demand, higher home prices have accelerated. The same trends that were true, well, they're even more true. But the difference is in the past year, there's been such a shakeup because of interest rates. The powerful thing is housing demand, the housing demand story that's happened for the better part of 15 years. But the kind of short-term smaller story that is creating what I think this divergence between rents and single-family homes is interest rates. And I just think it's a really cool thing because we have followed all of these individual factors. We have followed the supply factor. We have followed the kind of home prices factor each. And yes, high housing demand should result in a similar trajectory. But because the Fed kind of put their fingers in the die or hands in the gears or wrench in the gears or whatever, they stopped, what was going to be a similar flow, and they've made it a little bit different.
What we were talking about, Matt, before we started recording is, what's gonna revert? Are the home prices gonna come down to where rents are, or does this giving a lot of room for rents to actually really move up in the next near future? Looking at that expense growth, I don't know if any operators have much room to lower rents.
Yeah, I think, at the very...
and who's affording these homes?
Of all of these
rates?
Yeah. Well, it lays out a possibility space in which there's a lower probability of rents going down than rents going up compared to single-family homes. If this is a communication of housing demand, then the long-term prospects, outside of the new apartments that came online, that's going to shake out. But I think that at that point we could see an analogous lift in the apartment rent market.
I also think that there's just not that much supply of single family homes.
Yeah, I think
right now. I think that if we had volume, so like there is. I may not be accurate to say there's a lot of demand. There's a ton of housing demand for single family homes. But there's enough demand to maintain prices.
Now, I would totally agree. My guess, and I just can't remember all the jumbles of reports I've read, is I'm pretty sure that apartment sales and apartment construction, they went down so much during the Great Housing Crisis. I think more than multifamily construction did. Rents were a little more stable than home prices, period, for that time period. And maybe that more consistent multifamily construction during the past 15 years has led to a little bit higher apartment units than there are there are single family.
I think the spigot all kind of got turned off, for a couple of for a couple of years. But I think the multifamily guys were quicker to get back into it, and obviously there's more scale and volume. There's just so many home builders after the great financial crisis that just got out of the business. They just left, and not that some multifamily guys got out also, but again, it wasn't like multifamily wasn't the big issue. Like there were some things underwater, and banks want, and like the multifamily were there foreclosures, 100%. Again, it was just a major financial crisis. Again, more economies of scale, you can get back into it, and you can build a lot more quicker because again, you're building at scale. Maybe not move as quick because you're not doing one small deal at a time, but
But then, so I forgot to give you the specific numbers. Now, when I did the rough math, it was apartment rents up 18% versus single-family home prices up 36%. That's like a double in terms of price growth.
Yeah, but rent growth and here's the other thing. We are comparing rent growth and price. Like they are two different things.
Yeah, and I got down a rabbit hole last night trying to figure out, and I'm still searching for a way to accurately compare the payments that people pay for their house, whether it's a mortgage, factor all that in, make it per square foot, compare that to a rental price. Because right now, yes, I think there's a really strong argument that that renting is less expensive than buying a home and paying a mortgage rate. But there is some difference. There's a wiggle room in how that's interpreted. And how much are they factoring in maintenance costs and I'm just super curious about it.
Well, try replacing couple water heaters, or,
especially per square
tree
footage,
falling
because I think that's the big thing that I think about is like, are they just taking the median rent and the median home or in the median mortgage payment and comparing those? Because I think that ignores the single family homes just give you a little more space. But yeah, the apartment list numbers were about the same as mine. They had single family home price growing by 43% compared to rents growing 22%. So ultimately, yeah, a very similar story, very similar graphs, and I was pleased to see that from the apartment list research team. Could you try? Speaking of graphs, if we could try one more time to reload the Harvard Joint Center for Housing Studies, their website. I'm kind of crossing my fingers here that it'll show up. All right. Oh, I'm grateful here. Okay.
Right.
Yeah.
So.
Before it really did say page could not be loaded, but we're showing a working page right here on the Gray Report, which I'm grateful for. I'm sure that followers of the Gray Report are well aware of these single family home trends. But to focus in on one aspect that we've alluded to is that the sales for existing homes are so much down. Are down so much compared to sales of new homes. And sales of homes in general are down. Now, that's no surprise to anyone. But for new viewers, yeah, the supply of homes for sale remain near record lows in early 2023. Now, this is another one of these graphs of which there are many in this report that shows the dramatic trend happens from the peak of 2007, where it had just under 14 months of supply, to, let's say 2019, when it went down to just about 7 months of supply. But the recent drop off, the kind of pandemic effect, I think, was between 2020, when it was around 6 months of supply, down to in 2021, there was only 4 months of supply. So that's what I think it was. A third of that supply was either taken out of the market, not for sale, for whatever reason, whether they were just staying at home or because of interest rates discouraging the sale. Yeah. That those 3 years are the small trend, but the big trend is this larger effect is like going down from the housing crisis. Or I'm sorry, the Great Financial Crisis. I still can't figure out the best name for that, because is it really the 2008 one? What? GFC. Okay, that's better. That's better to say. That's what my standard is not going to be.
Yeah, it's that old GFC.
Yeah,
the whole kerfuffle and 2008ish.
And yeah, that's good. That's just like these strange times or whatever we were saying. And
you were in some strange times, right?
Yeah.
I'll tell you what.
I do want to know again. Remember a couple months ago, or maybe it was just 1 month ago, we were talking about how Warren Buffett's Berkshire Hathaway invested so much good money into home builder stocks, and like that's a pretty good bet. High interest rates plus people still wanting houses. Then you're going to go to home builders because people don't want to move out of their existing house and get a new higher rate. Now, this is the second.
People, I think we might be like a little bit different. But I messed up the size of this window. But most people like new stuff. People like new houses. A lot of people, especially if people our age, are like, they're like, I've only lived in new houses. Like, I like it. It's brand new. Even though the new ones the construction quality of some of the new ones are questionable at best.
Yeah.
Depending on,
good point.
It always depends on what you buy. But I'm living in the newest house I've ever lived in. It was built in 1954, and it's so like I don't know.
Yeah.
But a lot of people want a new house. They want brand new. Mm-hmm. Nothing wrong with that. And that's what's reflecting. That's what's being reflective, is that people don't want a lot of this. People want something that's brand new, shiny. Gotta wait on builders to build it.
Yeah, I would agree, and I also think that in a way too, it's like, well, yeah, they also want a house, period. And if they can't get it because no one's moving out, then yeah, they'll have someone build. But to come back to this graph was the last one that I was thinking about as I was making my notes last night and just today. And it shows how from 2011, the share of homes for sale that were newly built was about 5%. And it has gone from there all the way up to now it's between 30 and 35%. for this year, for 2000.
And I mean the bottom of 2011, but I mean it still was looks like in the 10 to 15% range, 10 to 20% range until it dropped down to 5% in 2011, but now it's 25. I mean,
that's a good point. Yeah, the drop down began. So maybe if there is a normal, it was maybe between 10 and 20 or 15 and 20.
Yeah.
Like
so now we're 30. Yeah, we're 30. So we're almost double what we. Yeah.
Yeah, and you can also see an inflection point at the pandemic from near the middle of 2020. Really? It went from 20% in like a year, went from like 20 to 35% were new homes. Maybe that's a year and a half, but still, in a short period of time, it made up. It accelerated the previously existing trends that were largely driven by the 15 years ago GFC.
Matt, do you think millennials and certainly Gen Z also, but just millennials, both millennials, do you think that on average, do you think millennials are a little more, could take a millennial or Gen Z term, like a little bougie, a little like they kind of like they like nice stuff, that there's a lifestyle that they either are familiar with or have experienced or have seen, whether them growing up or they've seen their friends growing up, and there's a certain lifestyle that people are going for that is often unobtainable and probably financially not a great thing to shoot for. But it can also it can drive people to make more money and certainly spend money, probably racking up a lot of credit card debt. But I'm just this seems like another reflection of that, of like, I want something new, I want something nice, I don't want to fix it, and we're going to finance our way to get there, or figure it out, or we're going to borrow money from our parents, which it sounds like that's how most of these real estate deals are getting done. I don't know, any thoughts about that, and then just how that, I think that is, it affects the economy, because it's like, millennials are getting into should be prime earning years, and they're ready to spend a bunch of money.
I think that's an interesting point in context of
total, like,
the idea that well, I guess I can't wholly endorse that speculation, but it makes me think of how millennials may be this generation that makes less than their parents. So no matter what, if they're expecting something like they're used to, no, they've got to pare back their expenses because they're not going to be making as much as their parents. And then there's a second idea of like this wealth.
They're not making as much, but they want to live a similar life. They have the creature comforts.
Exactly.
And then this wealth transfer, that they're trying to bridge the gap. Or the credit card is the stopgap to
I think so. Yeah, we're just waiting for the great generational wealth transfer. But I have a feeling that every single baby boomer is going to be buried with all of their money. We're not going to get any of it. Millennials, they're going to be buried with it, and we won't see it.
There's I've seen some of it. It's already happened in some cases. I've seen talking to a family office not too long ago, and their person who's kind of running things was younger than I am, and run a pretty big size family office, and so I mean there's that transition is already taken place, but
in the employment world,
it's gonna in the employment world, just of like people retiring, moving on up.
But this family office person was running his own kind of families, okay, and he was that's good to know.
Hundreds of millions, billion plus dollars, and
that's interesting.
They stepped into that, kind of managing that wealth role.
I don't know, I still think that generational descriptions are a better description of like what everyone's doing in that particular decade or two, but is there a part of the boomer character that is kind of not like, clinging to, their active life, they're still in it, they're aging in place, they're not going to the nursing home, they're holding off the ravages of time by, seating themselves firmly in their job and working till they die, or this idea that there is it seems like, they're not going to give it up without a fight. I don't think that they want to lay off and relax but that's, that may be a stereotype, a pessimistic one.
I don't know. I think some do, some don't. I think some want to retire, but they still want all the control. I mean, look at Mitch McConnell. I don't know. Like they're wanting to hold on. I mean, look at all of the politicians.
And I say, exactly. I say that about baby boomers, but that's like every person. No one wants to lose control. No one wants to be less relevant. No one wants their role.
But there is, and again, like baby boomers are going to hate this, but like, there is a sense of entitlement, and I'm just throwing it right back at them. There's a sense of entitlement that baby boomers have. I mean, they're the generation, they didn't win World War II. Yeah. Their parents won World War II. And, then all of a sudden the handout started with, with everything that Nixon and the Johnson administration did in the administrative state, and whether that's, the Department of Education, the welfare state, exploded in the 70s, which is the time that they were growing up. So they had, cradle to grave. That's how they grew up, being taken care of. But they wanted all the glory, and they didn't want to feel like they were being taken care of. They were kind of the most like taken care of generation of all time. And, now generations were like, well, none of that's going to exist because we don't have any money for it, and it doesn't make any sense. And you guys have spent your money on all this stuff. And
the millennials
thing.
You know what I'm going to say? The millennials, they, all their avocado toast, first of all. I mean, I don't even get that far. And they killed cable television. All those articles, millennials killed this, killed that.
Yeah, yeah.
And again, like I think it is an expression of the preference of the times.
DirecTV still growing strong in my dad's house.
Okay, that's good. They're gonna keep things alive.
DirecTV, and general, that's they're keeping it alive.
But that is that kind of circling back to what you said. It's like we in the greater uncertain moment that we're in, whether it's housing demand or the economy, we're in between this point where we want to earn more than our parents, and then there's this looming wealth transfer that is expected to happen. It can't just like the money's not going to vanish. It's going to go somewhere. And
it's gone.
It's going to go.
Yeah, away. Well, it depends on how politics go.
Yeah,
it could all be.
Yeah.
Yeah, it could all be seized.
Oh, it's going to go into the phone lines for the BLS, and maybe they'll have someone answering the phone.
They are going to hire. They are going to hire a receptionist.
Yeah.
They will finally outsource someone to pick. Don't you think? How much money are we spending? And is it the most important thing that the federal government does? No, like that, but like it's something that they're doing. And if you put the phone line on there, at least have like they didn't even we were unable to leave a message, man.
Yeah.
They said that we could leave a message, and again, like we saw the healthcare.gov. I think the website's working now.
Yeah.
I think decade and a half later, but just not giving us a lot of confidence on giving these guys that much more money. I'm not saying we don't need, some rules of the road and regulations and things like that. I'm just saying like these guys aren't very good at managing any of the money.
Yeah.
And they don't want to go anywhere. They're clinging on to power. Good point. I'm not talking about politics. I'm talking about multifamily.
Society.
Matt, where are cap rates going to be in 3 months from now?
I see, they've got to be continuing to expand. CBRE says they're going to continue to expand till mid 2024. I'd like to split the difference between all this and CBRE's more extended cap rate progression, but I think that that right now is a really good time to either buy, but it's also probably a pretty good time to sell. If you're facing some of the loan maturities that are coming up, there is you
mean like if your choice is to sell now or in 3 or 6 months?
Exactly. Yes.
Do it now.
It'll be painful. It'll be more painful if you wait. It'll be if you're nearing the end of your investment cycle, then it's probably profitable to get out before, there's a little bit, there's going to be a rough winter and, at the beginning of the year. But if you are looking to buy, then you could get really started. Still might be a little bumpy in your first year, but man, there's so many signals of housing demand and just like strong, and even the apartment supply situation that is crazy for now is gonna lessen in like 2025 forward. So 2 years, I know what's happening. Maybe some parts of 2 years.
So, if you're an investor out there, what should you be doing right now? I mean, what do you think? And
I think I would be looking for opportunities and really keeping your eyes peeled, but not all. I think that what you said earlier was true. We're seeing cracks, and not necessarily cracks of weakness, but just realization among sellers. Look for a seller that has realized that's like, okay, I gotta kind of cut my losses and make a more profitable decision than weathering things out, because it's going to increasingly happen. And then I think that we'll see increased buying activity where things level out. Yeah. But we could see select opportunities for some good sales.
Yeah. Yeah, I think that's all right on track. I think getting ready, having conversations, staying in contact with brokers, lenders, still looking at deals, going after deals, getting close on them. We are doing a lot of axe sharpening. Yeah, our blades are very, very sharp. We're cutting a lot of, we're shaving hair and cutting paper. Yeah, because we're ready to go, but it's got to be right. And yeah. It's not gonna be on the Wall Street Journal that they're not gonna have an article headline saying, now it's time to buy commercial real estate. Now it's time to get back in multifamily. It's gonna seem really scary. Could be sooner than we think. Could be a little ways away. But all of a sudden, the opportunity all of a sudden is going to be there. Yeah, we've gotten like really close on a couple that just weren't all the way there. But all of a sudden, it's like if we had been out of the market, would have never even seen the opportunity.
And the market's going to bottom when it's scary. And when it still seems pretty risky, you'll see the headlines after the fact. And, by the time it shows up in the Wall Street Journal, it'll be, a couple months away.
And it's going to be the hardest time to raise money. Yeah. Because everyone's going to be like, are you kidding me? Rents are like falling off a cliff right now. Yeah. Prices are, is anybody even going to, people will say stupid things like, will people even live in apartments in the next couple of years? I'm like, I don't know if anyone can say that, but like saying things that are just so extreme. And then it's like, okay, now's the time. And we are, I think, getting close, but we've just gone through we've been going through all of our policies and practices and, just getting ready, because it's been a while since we bought a deal now. Yeah. It's crazy.
Well, and I think that's true for so many syndicators this year too.
Not all.
Yeah. well, some of them are buying for the wrong reasons, but I sympathize with these people. It's a dicey environment, and like I do think that there is still that element among sellers in general that are just stuck in 2021 as much as it's gradually gone down.
Yes. Well, it is 2023.
That's right.
It's been quite a year. Thanks again for watching The Gray Report. You can catch all these episodes and more. Make sure you're subscribed to the Gray Capital YouTube channel. Once you've done that, hop on over to the Gray Capital website. We got a newsletter you can sign up. It's the best business, graycapitalllc.com/newsletter. If you are an accredited investor and you're like, okay, I don't think these guys are BSing me, trying to just do some really quality stuff, want to be involved in a multifamily project, whenever that may be, you can pop over again, graycapitalllc.com or graycap.net is another option. Graycap.net is a shorter URL if you don't want to type in the LLC, which we don't even like doing that either. You can sign up for our investor portal, which will give you access to deals, which, again, we're sharpening the axe, we're redoing our systems. We've always wanted to have our existing investors and people who've already gotten in touch with us, they get the first shot of the deal. Sometimes we don't have a lot of room in our deals. And so, we're building out a process of, where if you're already in touch with us, you're in the portal, you're going to get access, kind of a first look. If you're not, and you hear about it like on the great, whatever, there might be some availability, there may not be, you're just not going to be the first to hear about it. So if you want to get the deal flow, graycap.net, to get your process started, make an account. Again, you can you can start seeing, we've got a whole kind of deal room, with all kind of documents, research. You can start doing your due diligence on us, because, obviously it's not the deal. I mean, the deal, it's got to be a good deal, but, if you're picking your jockey, not necessarily the horse, you want to pick up the group that you want to work with, that you trust, that you align with, you feel comfortable with as a strategy, the market. Just you want to make sure it's a good fit. It's better to do that beforehand rather than you're given a deal and then you're like, is the deal good? Are these guys good? Just first see if we're worth working with. And then if not, then you just don't have to look at any of our deals. It's easy as that. And if you're like, no, I think it'd be interesting to work with these guys. They've got a great track record and they do things a little bit differently and they use a lot of technology and aren't stuck in 2006. Give us a call, set up a meeting. We'll see if it's a good fit. We really appreciate everybody. Anything else? Well, we have another podcast, Matt.
We do.
We don't have another podcast, but from the Gray Capital, Gray Media Network, there is a new podcast out. It's called The Complex. Katrina Green, Gray Residential, which is Gray Capital's property management company. Katrina Green has a new podcast called The Complex, also on YouTube. It's already doing better than ours, Matt. They've already got like sponsors and stuff. She's crushing it because, the reason why Matt and I, and this episode's now going on even longer, but even though we were wrapping it up, this is the kind of like this is the B-sides. Matt and I do this format we thought was a little bit different. We're listening to all, multifamily podcasts, a lot of great ones out there. We're walking on the, walking in the footprints of giants or whatever. But what the typical multifamily real estate podcast is, you have another syndicator, you have another operator over across from you on Zoom or what have you. And you're like, tell me your story. How'd you get started? Tell me about your first deal. Tell me about you. What are you promoting?
Yep.
And you can learn a lot of really interesting things. But it's like the same thing over and over. Tell me about this. What motivated you? Tell me your favorite book. What was impactful in which is great.
Yep.
I didn't think there was enough talk about just what's going on in the market. And like, that's great for motivation, or if I'm curious about the industry, or as I just want to learn about people, which is, again, great stuff. But it's like, I'm an investor. What is happening? I need information. I need the best information to make decisions. There wasn't a lot focused on multifamily. It was like, Matt, I think that we might be able to do something. It started with the newsletter. Let's just put all the most important things you need to see in a newsletter, send it out once a week. That was greatly successful. And we're like, let's just talk about it. Let's we're already talking about it. Yeah. So it's like, let's have a discussion, breaking down these articles, and then giving some, anecdotal insights from what we're seeing in the market from our little sliver here in the Midwest. Although we are, pretty decent sized market players, we're in the ponds that we play in. Katrina's is a lot different, but it's different in a completely different way that anything else is out there. It's different from us. Again, there's a vacuum in the real estate content ecosphere of like property operations and property management.
Yeah.
And how connecting that to investors, but also people working in property management. Again, it's a lot.
It's not a one, because I've seen one-off things on property management, but the complex is more of like, there's a well of information and insights that you...
Some podcasts have like one episode is like talking about property management and like, but it's typically like how to find your third-party property management partner who's going to do all the actual work, and you're never actually going to know what happens at your property. You're just going to get like a monthly or weekly report and say, oh, these KPIs look good. Okay, good job. Why aren't we going to farm cash flowing?
Yeah.
There's a lot more going on. It's a fascinating, complicated, it can be ugly, it can be beautiful, fast moving, a lot of moving parts, challenging, can be very rewarding business that isn't talked about a whole lot.
And if you don't know about it, you should. It is crucial to understanding how the apartment market works and how these vague forces that we're just talking about with trend lines translates like actual what actually happens.
It's like you're like owning a race. It's like you're owning a race team, but you don't really know how the cars work.
Yeah.
Or what the drivers do, or you don't know the drivers.
Yeah.
But you're like, we've got some guy down there that's doing a good job, and we'll see what happens. And that works out for a lot of groups. But breaking down to specific topics, whether that's technology or centralization or just maintenance, best practices. If you're an investor, it's information if you don't know, which you probably don't unless you're in property management, you need to know.
Yeah.
Or if you know a little bit, it's going to be helpful because Katrina is bringing on guests from around the industry, people working in technology, different areas of property management, talking about the latest technology, tips, tricks, how to motivate people. Just people is the hardest thing.
And you'll get a fix of what the pressures are, what the worries are, and what the successes are, what the kind of stuff that like she is like hard, or what she's thinking about all day. Just on one episode, it's hard to avoid, and you kind of get that perspective that you can't get if you're talking about things from 1,000-foot view.
No, and so often Matt, the Gray Report, we're talking about things from a 30,000 foot view.
Yeah.
I mean, we're talking about, Mitch McConnell, going to sleep and what does that have to do with anything? But no, we're talking about, macroeconomics and how it may affect the industry nationally and maybe regionally and maybe some markets. And you, as an investor, you have to know all that stuff too. But if you don't know the micro aspect of it, like how the business, what are the actual challenges of the business?
Yeah.
And those, like, a lot of people know them. A lot of people know that property management, real estate is like really antiquated, but it's way worse than that.
It's complicated.
And that's why it's called the complex.
Yeah.
It's complex, and everyone calls them apartment complexes, even though no one in the industry really does. So it's a good little play on words. So check it out on the Great Capital YouTube channel. Subscribe. Check out her the Complex podcast, wherever you can find your podcasts. And then you're going to be set. You got your micro, you got your macro, and maybe we'll do something in between. What's in between? There's just different people.
Yeah.
Like,
yeah. That's a good idea.
Maybe we can do that.
Yeah. Got it.
Thank you for watching the Gray Report. If you are still here, and if you have not liked the video, you need to, because you spend enough time to like the video. Thank you so much. Check us out. Talk to you soon. Have a good rest of your day, week, month, year,
quarter,
life.